Hi, welcome to another session of International Business, and today we would be discussing the balance of payments. First of all, what is balance of payments? Balance of payments is the method countries use to monitor all international monetary transactions at a specific period. Usually, the balance of payment is calculated every quarter in every calendar year. All trades conducted by both the private and public sectors are accounted for in the balance of payments to determine how much money is going in and out of a country. If a country has received money, this is known as credit. And if a country has paid or given money out, the transaction is counted as a debit. Theoretically, the balance of payments should be zero, meaning that assets and liabilities should balance. But in practice, that is rarely the case. Thus, the balance of payments can tell the observer if a country has a deficit or a surplus and from which part of the economy the discrepancies are stemming. The balance of payments is an overall statement which records all the monetary transactions made between residents of a country and the rest of the world during any given period. This statement includes all the transactions made by or to individuals, corporates, and the government, helps in monitoring the flow of funds to develop the economy. When all the elements are correctly included in the balance of payments, it should sum up to zero in a perfect scenario. This means the inflows and outflows of funds should balance out. However, this does not ideally happen in most cases. Balance of payment statement of a country indicates whether the country has a surplus or a deficit of funds. That is, I have already told you, when a country's export is more than its imports, its balance of payment is said to be in surplus. On the other hand, balance of payment deficit indicates that a country's imports are more than its exports. Tracking the transactions under balance of payment is something similar to the double entry system of accounting. This means all the transactions will have a debit entry and a corresponding credit entry. A country's balance of payment is vital for the following reasons. Balance of payments of a country reveals its financial and economic status. Also, it can be used as an indicator to determine whether the country's currency value is appreciating or depreciating. Balance of payment statement helps the government to decide on fiscal and trade policies. It provides important information to analyze and understand the economic dealings of a country with other countries. Also, by studying its balance of payment statement and its components closely, one would be able to identify trends that may be beneficial or harmful to the economy of the country and thus then take appropriate measures. How the balance of payments gets divided. So, if we actually see, it is divided into three main parts: the current account, the capital account, and the financial account. Now, within these three categories, there are certain subdivisions, each of which accounts are for a different type of international monetary transaction. If we see current account, so it is used to mark the inflow and outflow of goods and services into a country. Earnings on investments, both public and private, are also put into current account. Within the current account are credits and debits on the trade of merchandise, which includes goods such as raw materials and manufactured goods that are bought, sold, or given away. And that is possibly when are they given away? In the form of an aid. So services, what does services means? It is the receipts from tourism, transportation, something like a levy that must be paid in Egypt when a ship passes through the Suez Canal, or a ship passes through Sri Lanka. So if you're using those territories, then you would be paying the taxes from there. So engineering business services fees like from lawyers or management consultants, and royalties from patents and copyrights. Now, when combined goods and services together make up a country's balance of trade. So, it is the combination of goods and services together that is country's balance of trade. Now, the balance of trade is typically the biggest bulk of country's balance of payments as it makes up total imports and exports. If a country has a balance of trade deficit, its imports are more than its exports, and it has a balance of trade surplus, it means that its exports are more than its imports. Also, the receipts from income generating assets such as stocks, like in the form of dividends, are also recorded in the current account. The last component of current account is unilateral transfers. What are these transfers? These are the credits that are mostly workers' remittances, such as salaries sent back into the home country of a national working abroad, as well as any foreign trade that is directly received. So, all these things come under the what is known as unilateral transfers. Now, what are the factors affecting the balance of payments? A current account deficit could be caused by factors such as the rate of consumer spending on imports. Something like during an economic boom, there will be increased spending, and this will cause a deficit on the current account. Then, international competitiveness. If a country experiences higher inflation than its competitors, exports will be less competitive, leading to lower demand. Also, the exchange rate. If the exchange rate is overvalued, it makes exports relatively more expensive, leading to a deterioration in the current account. Now, structure of economy. So, the deindustrialization can harm the export sector. Then, the capital account is where all international capital transfers are recorded. This refers to the acquisition or disposal of non-financial assets like physical assets such as land, or non-produce assets which are needed for production but have not been produced, like a mine used for extraction of diamonds. So the capital account is broken down into monetary flows branching from debt forgiveness, the transfer of goods and financial assets by migrants leaving or entering a country. So the transfer of ownership on fixed assets such as equipment used in the production process to generate income, or the transfer of funds received to the sale or acquisition of fixed assets, gift and inheritance taxes, death levies, and finally uninsured damage to the fixed assets. Now, we'll see how the capital account works. So, the changes in the balance of payments can provide clues about a country's relative level of economic health and future stability. The capital account indicates whether a country is importing or exporting capital. Big chances in the capital account can indicate how attractive a country is to foreign investors and can have a substantial impact on exchange rates. Now, because all the transactions recorded in the balance of payments sum to zero, countries that run large trade deficits, like current account deficits, like in United States, must by definition also run large capital account surpluses. So this means more capital is flowing in the country than going out, caused by an increase in foreign ownership of domestic assets. A country with a large trade surplus is exporting capital and running a capital account deficit, which means money is flowing out of the country in exchange for increased ownership in foreign assets. Now, it is important to remember that the US trade deficit is the consequence of foreign investors finding US assets particularly attractive and driving up the value of dollar. Now, should America's relative appeal to foreign investors fade, the dollar would weaken and the trade deficit would shrink on its own. After this, we come to the financial account. Now, in the financial account, international monetary flows related to investment in business, real estate bonds, and stocks are documented. Also, it includes government owned assets such as foreign reserves, gold, special drawing rights held with International Monetary Fund, private assets held abroad, and direct foreign investment. So, assets owned by foreigners, private and official, are also recorded in the financial account. Also, it is a record of all transactions for financial investments, like it includes the direct investment. So, this is the net investment from abroad. For example, if UK firm builds a factory in Japan, it would be a debit item on UK financial account. Then portfolio investment. Now, these are financial flows such as purchase of bonds, gifts, or savings in banks, and they include short term monetary flows known as hot money flows to take advantage of exchange rate changes. Example, foreign investors saving money in a United Kingdom bank to take advantage of better interest rates will be a credit item on the financial account. Now, if we compare the capital account versus financial account, we can check that in recent years, many countries have adopted the narrower meaning of capital account used by International Monetary Fund. It splits the capital account into two top level decisions, the financial account and capital account. The capital and financial account both measures net flows of financial claims, that is, the changes in their asset position. An economy stock of foreign assets versus foreign liabilities is referred to as net international investment position, or simply net foreign assets, which measures a country's net claims on the rest of the world. If a country's claims on the rest of the world exceeds their claims on it, then it has a positive net foreign assets and is said to be a net creditor. If negative, a net debtor. So the position changes over time as indicated by the capital and financial account. So the financial account measures increases or decreases in international ownership of assets, whether they be individuals, business, governments, or central banks. Now, these assets include foreign direct investments, securities like stocks and bonds, and gold and foreign exchange reserves. The capital account, under this definition, measures financial transactions that do not affect income, production, or savings, such as international transfers of drilling rights, trademarks, and copyrights. What is the difference between current versus or capital account? So the current and capital account represent two halves of a nation's balance of payments. The current account represents a country's net income over a period of time, while the capital account records the net change of assets and liabilities during a particular year. In economic terms, the current account deals with the receipt and payment in cash as well as non-capital items, while the capital account reflects sources and utilization of capital. The sum of current account and capital account reflected in the balance of payments will always be zero. Any surplus or deficit in the current account is matched and cancelled out by an equal surplus or deficit in the capital account. The current account deals with a country's short-term transactions or the differences between its savings and investments. Now, these are also referred to as actual transactions, as they may have a real impact on income, output, and employment levels through the movements of goods and services in the economy. The current account consists of visible trade, that is export and import of goods, invisible trade, that is export and import of services, then unilateral transfers, which we have already discussed, the transfers from the people working abroad, their remittance of salaries, that comes in unilateral transfers, and in investment income, like income from factors such as land or foreign shares. Now, the credit and debit of foreign exchange from these transactions are also recorded in the balance of current account. The resulting balance of current account is approximated as the sum total of balance of trade. Now, we can take an illustration for that. Let's say if for the year 2018, the value of exported goods from India is rupees 80 lakhs and the value of imported items to India is 100 lakhs, then India has a trade deficit of how much? 20 lakhs for the year 2018. Now, balance of statement acts as an economic indicator to identify the trade deficit or surplus situation of a country. Analyzing and understanding the balance of payments of a country goes beyond just deducting the outflows of funds from inflows. As I've told you above, these are the various components of balance of payments and fluctuations in these accounts, which provides a clear indication about which sector of the economy needs to be developed. The balancing act. Now, the current account should be balanced against the combined capital and the financial accounts. However, as mentioned above, this rarely happens. We should also note that with fluctuating exchange rates, the change in the value of money can add to balance of payment discrepancies. If a country has a fixed asset abroad, this borrowed amount is marked as a capital account outflow. However, the sale of that fixed asset would be considered a current account inflow, that is, earnings from investments. The current account deficit would thus be funded. When a country has a current account deficit that is financed by the capital account, the country is actually foregoing capital assets for more goods and services. If a country is borrowing money to fund its current account deficit, this would appear as an inflow of foreign capital in the balance of payments. Now, liberalizing the accounts. The rise of global financial transactions and trade in the late 20th century spurred balance of payments and macroeconomic liberalization in many developing nations. With the advent of the emerging market economic boom, developing countries were urged to lift restrictions on capital and financial account transactions to take advantage of these capital inflows. Now, many of these countries had restrictive macroeconomic policies by which regulations prevented foreign ownership of financial and non financial assets. The regulations also limited the transfer of funds abroad. With capital and financial account liberalization, capital markets begin to grow, not only allowing a more transparent and sophisticated market for investors, but also giving rise to foreign direct investment. We can take an example here that if the investments in the form of new power station would bring a country greater exposure to new technologies and efficiency, eventually increasing the nation's overall gross domestic product and by allowing for greater volumes of production. Liberalization can also facilitate less risk by allowing greater diversification in various markets. Some economists believe that the liberalization of balance of payment restrictions eventually leads to financial crisis in emerging market nations such as Asian financial crisis. Now, what are the categories of transactions of balance of payments? The transactions recorded in the balance of payments accounts can be categorized as autonomous transactions and accommodating transactions. Now, what are autonomous items? These refers to those international economic transactions which takes place due to some economic motive like profit maximization. Now, these items are also known as above the line items. Autonomous transactions, these are independent of the state of balance of payment accounts. For example, if a foreign company is making investments in India with the aim of earning profit, then such a transaction is independent of the country's balance of payment situation. So, autonomous transactions, they take place on both current and capital accounts and they are independent of the country's balance of payment situations, but they carry an economic motive. On the current account, the merchandise exports and imports of goods are autonomous transactions. Whereas on the capital account, receipts and payments of long-term loans by private individuals are autonomous transactions. Now, what are accommodating items? Accommodating items refers to the transactions that are undertaken to cover deficit or surplus in autonomous transactions. Such transactions are determined by net consequences of autonomous transactions. Now, these items are also known as below the line items. Accommodating transactions are compensating capital transactions which are meant to correct the disequilibrium in the autonomous items of balance of payments. For example, let's say if there is deficit in the current account in balance of payments. Now, this deficit will be settled by capital inflow from abroad, and that would be an accommodating item. The balance of payments, if we summarize everything, it is the method by which countries measure all of the international monetary transactions within a certain period. Now, the balance of payments consists of three main accounts we have discussed. First, current account, second, capital account, and the third is financial account. The current account is meant to balance against the sum of financial and capital account, but it rarely does that. Also, there are two types of transactions: autonomous transactions and accommodating transactions. Autonomous transactions are independent of balance of payment situations, whereas the accommodating transactions, they takes care of whether there is surplus or deficit. If there is deficit, then the accommodating transactions would try and balance the balance of payment situation of the country, and hence they are dependent on the balance of payment situations. If we see now, globalization in the late 20th century has led to BOP liberalization in many emerging market economies. Now, these countries lifted restrictions on balance of payments accounts to take advantage of the cash flows arriving from foreign developed nations, which in turn boosted their economies. These are the references, and thank you for listening.